Our discussion will focus on the so-called Reddit rebellion, in which ordinary retail investors bought stocks that were boosted on various social media sites. In particular, and over the last few weeks, we've seen ordinary people, that is, non-professionals, buy distressed companies such as the video game retailer GameStop, as well as a handful of other stocks that had been heavily shorted by hedge fund managers. Shorting, to preview the discussion later, is a way to make money when you expect that the price of a stock will fall. While the economic fundamentals might not have supported buying these stocks, small investors battled professionals, many of those small investors using the financial investment phone application named Robinhood. Now, the terminology here may sound technical, but beneath the surface, there are themes common to the human experience: greed, revenge, risk-taking, emotional roller coaster rides, colorful names and characters such as Vlad and Roaring Kitty, and parallels with other moments in history. Additionally, and importantly for the Rockefeller Center, this episode also involves public policy. We'll get into the details over the course of the evening, but let me introduce our two speakers. It's a delight to welcome Peter R. Fisher. He teaches at the Tuck School of Business at Dartmouth College, where he's a clinical professor. He's on the board of governors at the Financial Industry Regulatory Authority, also known as FINRA, which is an independent, non-governmental organization that writes and enforces the rules governing registered brokers and broker-dealer firms in the United States. Additionally, he serves as a director of the Peterson Institute for International Economics. Prior to joining Tuck in 2013, Mr. Fisher worked for 10 years at BlackRock, where he served in several capacities, including head of fixed income portfolio management and chairman of BlackRock Asia. From 2001 to 2003, he served as the Undersecretary of the United States Treasury for Domestic Finance. And from 1983 to 2001, he worked at the Federal Reserve Bank of New York. Our other panelist is an alum of the 1971 graduating class at Dartmouth, Curt Welling. He's also a 1977 graduate of the Tuck School of Business, and he currently is a clinical professor of business at Tuck who teaches courses at the intersection of business, society, and government. Prior to joining Tuck, Welling served as the president and chief executive officer of Americares for 11 years, guiding that organization and delivering $9 billion in medicines and supplies around the world. Before leading Americares, Professor Welling worked in the investment banking and securities industries for 25 years. Finally, at other points of his career, he was the head of global equities at Credit Suisse and the head of capital raising at Bear Stearns. Now, this event is going to be a conversation between our two panelists, and we've decided to give each of them an opportunity to present a brief introduction to the event, and we'll start with Curt Welling. Then we'll open it up for questions, and I will begin by asking a few questions myself, and then turn to all of your questions. And I encourage you to submit your questions in the Q&A feature of the chat. So with that, I want to turn it over to our two panelists, and we look forward to this evening. Thank you.
Thanks, Jason, and greetings, everyone. It's a pleasure to be with you this evening. I have to say, with that introduction talking about greed, revenge, conspiracy, it wasn't clear to me whether we were talking about market structure and public policy or daytime television. I thought I would start by reflecting on the title here, which is whether we're talking about old wine in new bottles or new wine in this circumstance. And I guess my overall thought about that dichotomy is that the underlying motivations, some of the excesses, some of the activities and the objectives of the participants here are pretty much old wine. But the structure, particularly the way technology intersects with the equity marketplace today, is more than just a new bottle. It's almost unrecognizable packaging. And I'm quite sure that we'll get into talking a little bit about what some of the public policy, legal, and regulatory challenges are as a result of that acceleration of information processing technology and the advent of social media. I thought I might just take a minute or two and say, from our perspective, there are sort of four groups of actors in this soap opera. And we thought it might be useful to identify them by type and role. The first is obviously regulators. The Depository Trust Company, the CFTC, the CBOE, FINRA, on which my colleague, Professor Fisher sits, the board he sits, and the various exchanges. And to some extent, the exchanges are profit-making entities, but the overall objective of these actors is to ensure the liquidity, transparency, and the healthy functioning of the marketplace. They're the custodians of the marketplace. And so their primary objective is not profitability, but it's the integrity of the market, recognizing that liquid and transparent markets in the United States are one of our most important national assets. The second group of people you have are investors. And investors are well understood and well known to all of us. Presumably each of us in some way is an investor, either directly or indirectly. Retail investors, which recently have consumed a greater percentage of the volume of trading activity in markets. Estimates are that retail investors today account for between 15 and 20% of average daily trading volume, which is a fairly significant increase, although the market is still largely institutionalized. Many different types of institutions, active investors, passive investors, and investors are motivated by one objective, which is they want to maximize risk-adjusted returns, and they're looking for a variety of strategies which allow them to do that, either on an absolute basis or relative to some benchmark. We'll talk a little bit about the motivations of some of the actors that Jason mentioned earlier, particularly short sellers, I'm quite sure. There's a third group of people, which are information providers. And as you all know, information providers play an enormously important role in providing liquidity and encouraging and facilitating transparency, whether they're research analysts, technical analysts, data providers, and so on. Their objective is to maximize the impact of their research and the circulation of it and so on. And most of these research sources have products which they sell for a profit. Sometimes they're proprietary, sometimes they're in the public domain. But obviously information access, information symmetry, and information availability are very, very important elements to providing an efficiently functioning market. And in this instance, we have the additional question of what's the nature of the information that was being produced and presented on the Reddit platform in the days and weeks leading to the GameStop event. And then finally, we have brokers and dealers who are also important parts of making the market work. Brokers, Robinhood is the one that is front and center here, but you know them all. You know the big investment banks, Goldman Sachs, Morgan Stanley, et cetera, et cetera. You know the discount brokers, Charles Schwab, TD Ameritrade, and so on. These are intensely for-profit entities. They make money by accumulating both assets and volume. It's a very competitive business. And we're going to talk tonight mostly about the retail aspect of brokerage. On the other hand, you have dealers. And as the marketplace has evolved, back in the day when many of the people on this call were active in financial markets, I'm quite sure that the overwhelming majority of transactions were executed on an exchange someplace, whether that was the NASDAQ marketplace or New York Stock Exchange or the American Stock Exchange or an options exchange. Now we have this phenomenon where we have used to be referred to as a third market, where independent market makers are executing an extraordinary high volume of trades. And they're doing this at speeds which were unthinkable, which are almost hard to contemplate, where they're able to execute a high volume of transactions in a fraction of a second or a second electronically. They obviously are volume driven, and the source of their profitability is related to their ability to generate volume of order flow. And we'll probably get into talking about the economics of order flow here. So the unifying thing for all these people is they all make their living, and they all, to some degree, have a stake in having a marketplace that works, that's well regulated, that's healthy, that in which the public and all actors have confidence. It's pretty clear, however, in this instance, and I think from their respective roles, that their interests are not always perfectly aligned. And one of the ways in which they're not perfectly aligned is profits. Another is with respect to how they think about risk. So let me turn it over to Peter for his thoughts.
Thank you, Curt, and thank the Rockefeller Center for having us here. I just thought I'd say a few words about why we regulate securities markets. I mean, picking up on where Curt left off, and then a few words about the economic context. I mean, we do regulate in a paternalistic way what brokers and dealers sell to their customers. We worry about their sales practices. We worry about them treating their customers fairly. This goes back years and years ago, 1930s, before the SEC was invented, people pumping and dumping securities, encouraging people to buy risky securities they didn't understand. And so we do regulate this. It is paternalistic. It's worth comparing where we were 12 years ago during the financial crisis when mortgages played such a big part. Not only were many Americans induced to take out mortgages they didn't understand, but many investors bought mortgage-backed securities they didn't understand, the volatility and the leverage of which were not understood. And we thought about that as an area of appropriate regulation and supervision. So the relationship between the brokers and the customers is something we do regulate. Now, what's a little new here is the gamification of trading. We used to think that a broker would have to make a recommendation to buy or sell a security in order to have a relationship with a customer or something we would supervise. But now, with the back and forth in app-based trading, if you will, and the online trading, maybe the brokers are inducing people to trade with regardless of sign, whether there's a recommendation or not. And so Gary Gensler, President Biden's nominee to be chairman of the SEC, in his hearing on Tuesday, referred to needing to look into the gamification of trading and whether this creates new hurdles and new challenges. And that's certainly a major area regulators will be looking into. Another reason we regulate, as Curt alluded to, is to make the system resilient. And we specify how much margin, how much collateral customers have to put up if they borrow in order to buy a security. And we regulate how much capital the brokers and dealers have. And we also regulate, and they regulate it themselves, the clearing houses regulate how much margin they require member firms to put up against the risk that they can't settle their trades, because the clearing houses ultimately become the custodian and the settling agent of every trade. And that's something that became quite controversial here when Robinhood was had to put up billions of dollars in extra margins suddenly. But that's so the clearing house can protect itself. Now, an area that regulators and others will be looking into is whether those requirements are transparent and fairly imposed on all broker-dealers on the same terms. So these are perennial issues. Maybe that's the old wine, but they certainly are coming up in new ways here. I'll end by just saying there's a broad economic context, and stock market manias do happen. That's a matter of opinion, and maybe only after the fact we look back and decide whether this is an era of manias. But clearly, the very easy monetary policy that the Fed has engineered for macroeconomic purposes is creating fast and loose, momentum-based trading strategies because of the lack of a reference for value with very low yields on fixed income investments. And that certainly is playing a part, but that's a little bit to one side. But maybe we'll touch on some of those issues if you have questions. Let me stop there and bring Jason back in.
Thank you very much. That was really helpful to kind of set the stage. I want to follow up on a lot of these themes. And again, I urge everyone at home or wherever you're watching this to submit questions in the Q&A because I want to get to your questions as well, but I'll try to move back and forth. I guess I want to pick up on a few things that were just mentioned. So you mentioned this being controversial, these capital requirements. At the start of this saga, Robinhood and several other firms, I believe, suspended trading on this GameStop stock for a while. And I got the sense that small investors felt betrayed, like the big guys were rigging the system. We hear talk of these capital requirements in clearing houses and the need to invest billions. I was wondering if you could just elaborate on that whole system and why there was that temporary halt to trading and what that means, if there's anything untoward or unusual about that.
Well, the level of volatility was unusual, and that gave rise to this. But a clearinghouse becomes the settlement agent when every securities trade settles. So someone bought and someone sold. But in the last instance, we turn the clearinghouse into the counterparty on each and every trade in order to make sure it goes smoothly. Now, to ensure that everything gets done, the clearinghouse requires every member to post some amount of collateral against the risk that they will fail to deliver their side of the bargain so that we can keep the markets going. Now, when volatility or volume change dramatically, and they both did in this case, then it stands to reason the clearinghouse may need more margin, more collateral from the member firms to secure them against the risk of any one broker failing. Now, what happened in this case, which it doesn't happen every day, surely, is part of that agreement in which Robinhood, I'm referring to what I've read in the press, posted more collateral. Robinhood agreed to lower the volumes on its trading so that the volumes wouldn't continue to grow. Now, it's a matter of investigation, and I don't know the answer, whether Robinhood treated all its customers equally when it slowed down trading, when it prevented trading. That would be something the regulators will be looking into. But it's not atypical for that to happen. It is for more margin to be demanded. It's a little extraordinary in my experience for it to involve an agreement to suppress volume, if you will. And that's what happened in this case, to avoid an even bigger margin call on Robinhood, as I understand it.
Jason, I also think it's fair to say, with respect to the sentiment that you heard expressed by a number of market participants, principally retail actors who were seeking to buy shares and were not allowed to. It's extremely unlikely that any, or if so, very many retail investors understand the complexity of the settlement and margin rules that operate behind all of these trading things. So it's a perfect set of facts to hypothesize a conspiracy because it seems unfair.
Yeah, thank you. And just to clarify here, when we've mentioned regulators at several moments, are we talking about the SEC primarily, or are there other important regulators that we should be focusing on here?
Well, in this case, the collateralization rules are coming from the clearinghouse, which is owned by the Depository Trust Company Corporation, which is a subsidiary of the National Securities Clearing Corporation, NSCC. They're not really regulators other than of their member firms. They're cooperatives, if you will. And so they regulate the terms on which they're members, but the terms on which they do these things are regulated both by, I believe, the SEC and New York State. They're companies in New York State, and the SEC has authority over them as well.
Thank you.
There are a lot of regulators. The New York Stock Exchange has a regulatory component. The SEC makes overall regulations with respect to market structure and the operation of certain companies. There's FINRA, which is the successor to the NASD, on which board Peter sits, which is a self-regulatory organization operating with the license, if you will, of the Securities and Exchange Commission and the government. So there are lots of different regulators that regulate various aspects of this process.
That'll be important later, especially when we get into the policy aspects, because the political authority or clarity or accountability, it sounds like it's distributed from at the national level, at the states, as you suggested. Even the profession itself is self-regulating in some instances. So another question: this much of this was brought on by short selling, especially at hedge funds that were betting that the price of this GameStop stock would decline, other stocks as well. I guess if you just characterize overall, is short selling good or bad for markets? Provide an overview of what it is we're talking about. We hear rationales related to liquidity of markets. I just wanted to get your thoughts on all of that.
Curt, go ahead.
Yeah. It's for some reason, short selling gets no respect. Short selling carries this sort of innuendo that there's something sort of nefarious or less worthy about it. All a short seller is doing basically is betting against the price appreciation of a stock. And so it's neither bad nor good. It's just taking a point of view on the direction of a stock and the valuation of the stock. Physically, the way it works is, and it seems odd to people that you can sell something you don't have, but basically a short seller executes a transaction to sell a stock, and then in order to settle that transaction, borrows stock from someone who does, and there's a very active market in securities lending, and they deliver that stock with the idea that at some point in the future, they're going to have to go back into the market and buy that stock and give it back to the entity that lent it to them. So that it's all very carefully regulated. It's all subject to the same kinds of margin and equity requirements that Peter described. The proponents of short selling, of course, say, number one, it would be unreasonable not to allow people to make these wagers against the appreciation of a stock or against the quality of the valuation, number one. And number two, there are people, and there have been studies that tend to support this idea, that the idea of short selling does enhance the underlying liquidity in markets. That because it creates, if you will, a counter influence to the unrestrained appreciation of a stock, which gets to a valuation level which someone in the marketplace views as unsustainable. So you don't have to own the stock to sell it. You can just make a bet against the appreciation. So I would say it's got a bad rap, and I would say it probably does provide a useful, play a useful role in terms of promoting and encouraging liquidity and facilitating this two-sided marketplace for equities.
We had a question come in that's just a nice follow-up on this one from Zachary. So Zachary writes, in January, as shares became almost impossible to borrow for GameStop, so many shares were sold naked. The settlement risk in the system and the clearinghouses, it might be likely to continue to climb, in part because many shares are failing to deliver. So how can the SEC and regulators ensure that illegal naked shorting is not allowed to happen in the first place? These are wonderful terms at any rate. So.
Peter, do you want to take that with respect to the integrity of the clearing process?
You're doing great with short selling, Curt. Continue.
Yeah, I think the answer is that the mechanics of short selling are extremely well established and they're aggressively enforced. So if you sell a stock that you don't own and you fail to deliver, you're subject to a very significant financial liability. So that the way in which the marketplace polices this is, number one, economically. And number two, if someone were to engage in a consistent pattern of this behavior, there would be disciplinary action that could be brought against them as well.
Okay.
What was once, forgive the digression one layer further, short selling is certainly one activity, it takes place, but a lot of the going long and going short an instrument now takes place in the options markets, right, where you can take both sides economically of the same exposure, but you're not actually even bothering for the moment with the underlying security. And that's where a lot of this story seems to have played out in the options market.
Straddles and other ways to kind of play both sides, essentially. That's very interesting.
With much less capital, obviously.
With much less capital as well. So as a part of all of this, my sense from the Robinhood, the finances of how Robinhood operates, they get payments, to allow people to trade and route orders. So how is letting big firms like Citadel Securities pay to execute retail customers good for the mainstream investors, right? In the economics of how these apps are set up and how they make their own money.
A payment for order flow is certainly something that the regulators and Congress will be looking into, in which high frequency trading firms pay discount brokers and others to take their orders. And this has been what has led to retail investors experiencing free trading. You don't even pay a commission, because their broker is able to be remunerated by those to whom it's delivering this flow of orders. That poses a question of whether the customers are getting what we call best execution. How do they know they're getting best execution? Now, these are pretty exacting standards of how do we know that, but that's certainly going to be a big issue. I don't think we know the answer to whether that will survive, payment for order flow or not. And that's, I think the policymakers are going to look into that with a great deal of scrutiny, both Congress and the SEC, I would expect. And
it's a very, very big business. So just order of magnitude, Charles Schwab was paid $1.3 billion last year to direct order flow to specific dealers. There's nothing illegal or nefarious about this, because the dealers themselves are betting that they can execute that order flow profitably after they make the payment to the broker and make a fraction of a penny on millions and millions of trades. But Robinhood, for example, was paid $700 million. So to the extent that Robinhood's business model is to compete with this mobile app in a community that allows their investors to trade commission-free, the reason they're able to allow their investors to trade commission-free is because the dealers are paying them to execute that order flow in the third marketplace. And it's illegal in Europe. I think it's fair to all, someone may ask that question. It's a fairly controversial process. The dealers argue that it enhances the liquidity in the market and the probability of good execution. There's data on both sides of that.
So I was going to ask if other countries do things differently. So we're in a world with global capital, financial flows, but so much of this boils down to laws and institutions set by countries, right? Or are there international standards that, so it sounds like different countries can adopt different rules in this regard.
Yes, different countries. There are a number of areas where international security regulators cooperate, and that having to do with transactions that flow across borders. But what we're discussing today is pretty locally regulated here in the United States.
So several people are, and I was as well, are they're biting on the title, the financial bubbles, new wine, old bottles, or new bottles. I'm old enough to remember the Yahoo Finance chat boards of the 1990s. Is this the same thing? I mean, people have talked about financial bubbles, the Dutch tulip craze in the 1600s. So some of this might just be, more of the same. So one question we had from Elizabeth was, I'd like to hear more about the idea of gamification in this context. In particular, in keeping with this old wine, new bottles metaphor, I'd like to know what's new or unique about Robinhood's gamification of trading, what sets Robinhood apart from other banking, financial health apps, and how do the panelists think that the regulators might address this issue?
I don't know whether Robinhood's practices vary a lot from other online discount brokers. So I want to be clear, I'm going to refer to them all. But I think that encouraging people toward activity, let me say, giving people frequent flyer miles, the more you trade, the more I'll reward you in some way, whether with emojis or financially, is a gamification inducement for me to trade more, which may or may not be in every customer's best interest. So turning this into a game with beeps and blips and rewards is what people are referring to. I don't know that Robinhood's practices are any different from other online brokers, but that's the area we're talking about, where just as my iPhone, which I love and adore, induces me toward addictive behavior, and the app builders have hired psychologists to help them do that. So too, it seems, have the online brokerage industry figured out how to get us to spend more time in front of our trading screens. And the question is that something that we think is in the customer's best interest? Or is it something that is turning this into a game rather than something for prudent investors?
If you think about what's happened as a result of this ubiquitous access to communities and information, and very low cost or no cost ability to put capital at risk. We have the same thing in the sports betting world now with applications like FanDuel, for example. People are able to play the game in the stock market with very few barriers to entry, with lots of social encouragement. And it's in the high volume trading aspect, it has some of the characteristics of gambling. There's no question about it. If you want to read some salty language on this topic, I refer you to a recent article by Charlie Munger, who is Warren Buffett's investment partner, who had some very candid things to say about the utility and the morality of this kind of casino behavior in financial markets.
See, I knew we'd get into morality and, again, these enduring human themes. And so Bill had a question that kind of falls in these lines. Bill wondered if ordinary investors who are accustomed to working with a reputable institutional investor still trust that there's some rationality to the capital markets, or things gone completely haywire.
I think that the word that I will grab onto there is rationality. And we have 20, 30 years now of economists debating whether markets are irrational or respond to what we thought of as rational impulses, or whether they're emotional impulses. And Robert Shiller at Yale, a Nobel laureate, has pioneered a lot of the thoughtful work on, and his famous book, Rational Exuberance. Whether in the short run we can rely on markets to be what we thought of as rational. And I don't think that's really the point of departure. We hope it sorts out in the wash of buyers and sellers and over time. But you can't, I wouldn't take much comfort on any one day that I can explain to you why the stock market goes up 500 points one day and down 700 points the next. Our hindsight bias will kick in and we will come up with explanations for that. But it's only in the long run that I think the question goes to. And yes, I think investors can still have some confidence, but you have to be playing a long game, which is exactly what Warren Buffett and frankly, John Maynard Keynes would have advised us to.
Yeah, the only thing I would add to that is I'm not sure that we should be imputing rational behavior to the market. The market is the collective emotions and wisdom and information and judgments of all of the market participants. What we can say about the marketplace with respect to confidence is that the structure of the US equity marketplace is the envy of the world. It is, it provides a level of liquidity and investor protection and so on that is the most advanced with respect to each of those things of any marketplace in the world. So the structural integrity, which is dealing with these challenges, is very sound. I think most commentators would say. The rationality or irrationality is the product of the participants in the market, not the market structure itself.
Right, and I was struck by the phrase "over the long run," and in today's stock market, that might be different than viewed in the past. So average holding time for stocks has dropped, perhaps from years to months or even seconds in many cases, right? Fractions of a second, as we talked about. And so this gets us a little bit into the policy issues at stake. Should there be holding periods? Should people have to be required to hold stocks for a period of time, or taxes on those transactions that are rolling in, billions each second? Anything else that should be considered, from a policy standpoint?
Yes, we should consider them. Curt alluded to this. At present, millions of transactions are executed within the boundary of 1 second. And it's hard to grasp this, but there is what I describe simply as a war, the battle between the algorithms of various financial firms are trying to get their business done and executing purchases and sales, all running algorithms to try to execute this as smoothly as possible. And it really boggles the mind to think about how much gets done within the boundary of a second. And so the volume and the holding periods we look at, some of them holding periods are less than a second, less than a few seconds. And it's a big debate whether this enhances market liquidity, because there's so many buyers and sellers. And so the rest of us who don't want to play that game, we should be benefiting by very tight bid-ask spreads. how narrow this is. That would be something that would benefit us. But whether there's a social utility going on here of this huge game and the battle of the algorithms, whether it's something that we should be spending social resources on, you can take that view. It's a very hard issue to feel strongly. The longer I've thought about it, the harder I feel to come down on either side. Yay, I love it. No, it's bad. We should prohibit it. It's very tough. But I think the policymakers are likely to look into this. But the economic interests at stake in the volume of transactions that are executed at this speed between hedge funds and broker dealers and asset managers and the like, and high frequency trading firms are huge. So the stakes are also huge.
The arc of securities regulation over the last 30 or 40 years has been to continue to try and find ways to narrow spreads between offering and bid, to shorten the period of time between a transaction being committed and the time it's settled, to provide greater liquidity and access to the marketplace for the execution of transactions. And so that has sped up all aspects of trading. At the same time, the other significant phenomenon that's going on in the market is the rise of passive investment through index funds and negative and positive screen funds and so on, which are not actively trading securities and so on. I'll express a personal opinion here, which is I do not think it's likely that there will be a material move in the direction of regulating holding periods. I think that would be completely counter to this continued aspiration to provide transparency and liquidity and collapse the time between commitment and execution as short as possible. And nor as a matter of policy do I think you can justify a holding period. An arbitrary prohibition on the purchase or sale of a security for some period of time, like a cooling off period. It's hard for me to see how that could be justified in terms of what it would do to the marketplace.
Yeah, and it's funny because this question just came up in the question and answer period. Reg was wondering about these taxes and the volume of rapid transfers, whether or not that could provide some sort of common good. And so it's very interesting to be reminded that the narrowing of the bid and ask is a benefit of sorts, and I think probably people don't appreciate that quite as much as they might.
Well, some of us on this call are old enough to remember when stocks traded on the New York Stock Exchange in a quarter or a half a point spread between bid and offering. Mm-hmm. And then it was a question when they went away from fixed commission rates, whether they would break the eighth. Mm-hmm. And now, of course, stocks trade on a bid offered spread, liquid stocks of a penny or a fraction of a penny. So, and generally that's been good for investors, whether this volume of the battle of the algorithms, as Peter describes it, whether that's creating anything that's useful to society, which is useful to the financial system, I think is a debate. Mm-hmm. And whether that kind of activity would be encumbered in some way if there were a financial transactions tax, my bet is that you will hear some full-throated debate on the topic of a financial transactions tax.
Mm-hmm. So you had, when you're talking about when prices used to be in quarters or eighths, that immediately brought to mind the financial sheets, right? So turning to the back of a newspaper and going down the columns, and I don't know if that's still being done at Talk, if you walk people through that sort of exercise, or if it's just completely all on apps and everything like that. But it's getting into some of the information provision aspects of all of this. And are there any responsibilities, let's say, are there responsibilities for these information providers? Has Reddit created a new source of information that informs investors of their prospects, or are they liable for some of the things that they're sort of enabling in this sense?
Well, Reddit's just a platform where people meet to, in their Wall Street app. Reddit is providing a meeting place for people to come and share their perceptions about stocks and information about stocks and brag about their positions and question the integrity of people and so on. The the free exchange of information, the instantaneous sharing of information that exists in social media is a context here, but I'm not sure that there's any way in which it affects the securities marketplace that's any different than it affects a number of other marketplaces or social dynamics. One of the questions that will be probed here is whether or not there was collusion or a conspiracy to do something with respect to the price of a particular stock, GameStop or AMC or Chewy or some of these other companies that were affected here. And once again, that's an investigation which I think should and will take place, whether there was a securities law violation here in an attempt to manipulate the price of the stock.
Just quickly add, on either the long or the short side.
Right.
Right. The authorities are likely to look at both sides to see whether there were any legal norms broken.
On the short side. So we did have a question from Frank about, do you believe criminal charges will be arising from any of these activities? And is it just too early to tell, or if you had to speculate?
I'm sure the authorities are going to look hard at that, and they've got lots of data to look at, the various regulators. Whether they will or won't, I have no idea.
Yeah. In the absence of a smoking gun, which could always materialize, it's hard to imagine how criminal charges could be, a criminal case could be put together here. For some of the people who are on this call who have experience in the securities business, this goes back to the days of Ivan Boesky and your bunny having a good nose and the sharing of inside information about mergers. There has always been concern that there was a robust marketplace in the trading of information among securities market participants. And the question then becomes whether they're colluding to manage that information in such a way that they're trying to affect the price of a security, or whether that's illegal inside information. But there's certainly nothing in the facts that have been presented yet that present a strong prima facie case for some sort of illegality, I don't think.
I'm struck by how I started the session with reminding people of where we were just a few weeks ago and the political situation in Washington, and that had a social media component, and whether or not charges will, be followed up from that. So it's interesting that the financial world has its own version of all of this. There was a story late last month, meaning February, that cybersecurity found that bots were promoting the GameStop stop on social media before and after the frenzied rise. So I didn't know if that kicked this into yet another regulator, maybe the FBI, maybe, just like we're worried about election interference. Is there anything to worry about with respect to the intellectual or technological infrastructure and whether or not bots are responsible for this?
It's certainly a good question. I don't have any particular insight. I'm sure the authorities will be looking at all of the sources of information that may have induced people, and whether they were induced individually or whether they voluntarily jumped in with full knowledge of forethought, if you will, or whether there was collusion or manipulation. These are all hard legal issues. But the authorities, I'm sure, will be parsing all of the data from social media platforms and all of the trading exchanges data to try to parse
there is an element of this information sharing dynamic which cuts across a variety of aspects of society, and that's the difference between validation and the curation of information. In other words, some establishment of validity or truth to the information, and at the same time these platforms which are creating communities which become echo chambers with respect to what has been famously called alternative facts. It seems extremely likely that in the stock market, with respect to thinly capitalized stocks or stocks that have large short open interest and so on, that there may be alternative facts that are being exchanged by communities of people, just as there are alternative facts that were exchanged by people on January 6th, just as there are alternative facts in our politics today. And that's a problem because the platforms are disinclined for a variety of reasons to curate the information and to edit it, to validate it, to test it in some way. But it affects a whole range of activities in American life, of which financial markets are certainly one.
So we had a question that's related to the cybersecurity one, but it's talking about the Fed. And it's talking about if the recent breach at the Federal Reserve, whether or not this was an unrelated issue. And I guess I wanted to just get your quick thoughts on that, but then more broadly about the relationship between the Federal Reserve, interest rates, easy money, the whole macroeconomic policy and fiscal policy climate and context, and whether or not you could just wrap that into our discussion.
I think all investors need to be concerned about the security, the cybersecurity of the infrastructure of our capital markets and our banking system. So I don't think it's particularly retail investors. And I know the authorities work hard at trying to ensure that, but we've seen what happened to the federal government with SolarWinds. I don't know enough about the outage of the Federal Reserve's wire transfer system to know whether that could be linked here in any way. To your economic question, I think I'm certainly of the view that it would be a mistake to think that the extremely low interest rates the Federal Reserve has been providing for over a year now and have promised to provide going forward have nothing to do with the level of asset prices. Of course it does. It's done in part to try to pump up asset prices. Monetary policy works through the channel of asset prices. And so low mortgage rates stimulates home buying, and now we have house prices going up, even though interest rates have been low. So of course, that's a part of the backdrop. And when you get extremely low interest rates, as the Federal Reserve has been providing us, it makes it hard to run through the sort of dividend growth models that we use to value assets. When you put a zero in place of interest rates, it's really hard to apply some of these models. And that's what I alluded to earlier. Momentum is an important risk factor we look to in securities markets and investing. And it does seem to work out that if you buy things that have been going in one direction, they tend to go in that direction further. I'm simplifying that grossly. But momentum certainly plays a bigger role when the reference for value of interest rates is so low. So I think that's certainly a part of the puzzle. How much will be debated, but that it has an influence, I think, at least in my opinion, is clear.
So this episode caused political repercussions as well. So some hearings in Congress. You had a moment where Ted Cruz and AOC were joining forces to criticize this behavior. Senator Warren's letter, and in general, there's a couple of other issues out there, like whether or not I'm under the understanding that GameStop, there was more than 100% of the shares of the company might have been shorted at one time, or if there's disclosure, the SEC's disclosure regulations on how much in particular stock might be lent out or shorted at any point. So I was wondering if you could tack back to the political and policy considerations here, and especially in relation to those two items.
Curt, you want to go first?
No, I was just going to say, this is a bit snarky, but Ted Cruz and AOC, unlikely partners in demagoguery. I think we found a truly unique issue where they could both say something that they thought was going to put them on the side of some aspect of their constituency. Peter, go ahead. I'll share a thought in a second.
Well, I agree. I share Curt's sentiment, but I'll point out that we do care about whether brokers treat their customers fairly. I think that both the senator and the congresswoman jumped to the conclusion this was a case they were not being treated fairly. It appears to me, but more facts will come out, that this related to the clearinghouse margin call. And what I alluded to, Robinhood had decided itself to suspend trading in order to lower its margin requirement. But that's certainly an area to look into. But I think it's in the technical details it might have been misunderstood. So I think there are hosts of issues that policymakers will look into. That's sort of the perennial aspect of this. When you get a case of extreme volatility, it's worth refreshing our memory about that we care about treating customers fairly, but we also care about the resilience of the system. I hope I picked up all of those things, but Curt, maybe you want to add something else.
Well, I was just going to say no politician ever lost any votes by attacking Wall Street and saying they were in favor of the little guy. So I think that's almost de rigueur. And there's some really technical wonky stuff about the discretion that the clearing corp has to set the margin requirement as opposed to a rule and so on that will get looked at here. In terms of the fundamental regulatory responses and the fundamental aspects with respect to something that needs to be changed in terms of market structure, my guess is that that'll proceed pretty slowly, because when all is said and done, the public securities markets in the United States serve the economy very well. And it's important, I think, to see the aspect of this, and here I defer to the former Deputy Secretary of the Treasury, in terms of our credibility internationally in financial markets at a time when we've put $6 or $7 trillion worth of liquidity and new money into the marketplace in the last year. At some point, it's important to reflect on the confidence that the international community has in the rationality and the soundness of American financial markets when you have that volume of debt being held by international parties. So I think it'll go slowly, actually.
So we just have a few minutes left, and this has been a great conversation. I guess I want to do one small shout out or keep Tuck professors employed kind of statement. So I remember hearing my son's head, and we both turned when we heard this on the radio, that hedge funds were offering $200,000 a year for social media sentiment analyzers in the immediate wake of this. I don't know if any of this has changed how you are teaching students at Tuck or across the Dartmouth campus, but it certainly does seem to be an eye-catching number. And I don't know if you had already seen these kinds of positions, or this Reddit rebellion created a whole new industry and possible career path.
No, we're still teaching debits on the left and credits on the right, and you've got to make sure your sums add. The whole field of behavioral economics and creating big data around human behavior and decision making and so on, and the machine learning aspects of that and so on are obviously a big part of the kind of thing that high volume traders are using to construct some of these models. But I think those are more likely to be people who are training at MIT than at the Tuck School of Business just now.
I'll close with one reference to the question we have outstanding about whether trading's become more akin to the racetrack or the casino. And one of the things I do teach my students is that John Maynard Keynes made that observation 80 years ago, that as soon as we separate ownership and management, we create publicly traded companies, joint stock companies, we induce this kind of behavior where it's hard not to see that we've organized securities markets around the casino impulse in the short run. But maybe it induces people to hold more risk than they otherwise would have because they can sell it. And Keynes thought hard about whether we should prohibit stock trading and make people, when they invest, have it be like a marriage. You can't get divorced. But even he concluded, notwithstanding his skepticism, that we may be inducing more capital formation because we give people the sense they can always get out.
Thank you. Just a terrific discussion here of a very timely topic, and we'll have to see how things play out over the next few months and years or seconds in this particular case. I'm going to turn things back over to Joanne, who's going to close out the discussion tonight. But thank you very much for participating in this.
Our pleasure.
Pleasure.
Well, thank you all so much for sharing your expertise with us tonight. We're lucky to have such knowledgeable folks right in our backyard to help us sort out the complexities of this recent episode. And even an English major like me found it enlightening. To the audience, thank you all for joining us. Next week, it will be our last event of the winter term, which I find impossible to believe. On Tuesday, March 9th at 7 p.m., the Irving Institute Director Elizabeth Wilson will host Mark Shriver and Glenn Blumhorst, who will be discussing the 60th anniversary of the Peace Corps. This event is co-sponsored with the Center for Social Impact and the Dickey Center. We hope you can join us, and I especially hope you'll take a moment to fill out the survey on your way out the door. Thank you very much for joining us tonight.